Bretton Woods one happened back in 1944. So in Bretton Woods, New Hampshire, delegates from 44 countries from around the world met to really establish the International Monetary Fund, which ultimately became the World Bank Group. The three primary goals of this meeting were to, one, ensure exchange rate stability, two, prevent competitive devaluations, and then three, really to promote economic growth. What was really unique about this meeting, though, is that many of these countries had spent really a decade plus prior to that, really trying to insulate their economies, really set up all these barriers, to protect their economy from the economies of these other countries. So it was totally contradictory after all of those, concerted efforts to really put those barriers up, for all of those delegates to meet in Bretton Woods, New Hampshire back in 1944. So since then, we've had Bretton Woods 2, and according to a recent memo from Credit Suisse, we are now at Bretton Woods 3. I kind of set the stage with the Bretton Woods. If you can kind of just take it from there and run with it, what do those meetings mean? What was Bretton Woods 2? What was that backed by? And then how does that take us into Bretton Woods 3, and how are they kind of different? And how does that affect, ultimately the general population, and specifically, investors?
Yeah, and you did a fantastic job talking about Bretton Woods 1. So Bretton Woods 1 was, as you mentioned, it was the meeting that was held in Bretton Woods, New Hampshire in 1944. And this was towards the end of the Second World War. And essentially, what is very important for folks to understand, too, is that during the war, most of the war was fought on the European continent and in Asia. There was no war fought on the American mainland. We all know, of course, that Pearl Harbor was attacked by Japan. So yes, America was attacked, but there was no war fought on the American mainland. And of course, Americans, as they always do when there's crisis, they have creativity. And America started to produce and create at a record which we have not seen. They became an economic powerhouse of just producing all these goods and services that was needed in the war, and for the war effort by all of the different countries that was involved in the war. So a lot of goods and services came from the United States over and made its way over to Europe. So a lot of countries built up trade deficits with the United States. And back then you settled trade deficits with gold. So a lot of the world's gold started to flow into the United States. And as a result, for folks that know me, they know I like to butcher quotes, but there's essentially a quote, "He who has the gold makes the rules." And it really put the United States in a position of strength, of power. They were an economic powerhouse. Most of the world's gold ended up in the United States. And of course, victorious from World War II. All of the other countries was essentially bombed to rubble, had massive amount of casualties, unlike the world has ever seen. And of course, then that led to America negotiating this new monetary system from a position of strength and power, which ended up with them being the world's reserve currency. And at that stage, the US dollar became the world's reserve currency. It was there was a ratio between gold and dollars. I believe it was around $35 an ounce for gold versus the dollar at that stage. And what that meant was countries around the world could hold US dollars and then convert those dollars into gold. Now, right after World War II, the United States lost their way a little bit. As anyone does, as most successful countries do, they got involved in foreign entanglements, something which the founding fathers has always warned against. So wars in Korea, Southeast Asia, and of course, wars cost a lot of money, So at the exact same time, right after the Kennedy assassination, Lyndon Baines Johnson got into office and rolled out all of these social and welfare programs in the United States. And for listeners watching this, you're probably shaking your head going, yeah, the warfare state and the welfare state, you cannot satisfy that appetite. So spending was reckless and it was out of control, and the world took notice. The world really took notice. They took so much notice that in 1969, the International Monetary Fund created the SDR basket, special drawing rights, which is sort of a vehicle of a basket of currencies, which they set aside as a lifeboat because they saw a crisis coming, because they said, well, look at these folks that have the world's reserve currency. They're spending like drunken sailors. We got to have a lifeboat aside, which again, this led to a run on gold. Most of the people around the world saw what was happening. They said, and by people, I mean countries, leaders, bankers. And they said, well, let's exchange some of our dollars for the gold per Bretton Woods agreement. And there was a run on gold. A run so much on gold that in 1971, on August 15th, Richard Nixon had to close the convertibility of US dollars to gold, which shocked the world at that stage. It was called the Nixon shock. And that essentially changed Bretton Woods I, and we moved into Bretton Woods II. Now, as you can imagine, the world was shocked. There were shock waves felt everywhere. There was uncertainty. There was chaos.
You're talking about in Bretton Woods II, you're going into now. So Bretton Woods I effectively gave them the opportunity to really draw on, the lessons from the gold standard, the previous gold standard, and then ultimately lean on experiences that they got from the Great Depression right there as well, and how to really take that information and really do a post-war kind of build back, reconstruction, if you will. And then we're fast forward to the 70s, and with Nixon, and then we're in the Bretton Woods II stage. Got it. Okay.
Yeah. That's exactly. So the Bretton Woods II stage was in, but as you can imagine, he just closed the convertibility of US dollars to gold. This shocked the world. So everybody, I mean, there's amazing stories for folks that want to research this, where Charles de Gaulle actually sent ships from France to collect gold at the New York Fed during that time. So incredible stories surrounding that, but shockwaves was felt. Chaos, confusion, uncertainty. We saw inflation coming up. We saw fuel shortages in the 70s for all the folks that lived through that. But essentially, what really solidified Bretton Woods II was the establishment of the petrodollar. A meeting in 1973 was held between representatives and leaders and bankers in the United States and Saudi Arabia. And at that stage, they made an agreement that Saudi Arabia would sell oil to the rest of the world denominated only in US dollars. And essentially all the OPEC leaders jumped on board with that. And of course, there was an agreement that they would sell their oil in dollars. They would also buy bonds, usually US Treasury bonds, and hold a lot of US dollars and US denominated assets and reserves. As reserves, and then the U.S. of course would give military aid when needed and protect their country. That solidified Bretton Woods too, because again, as you can imagine, there were shock waves. There was, whoa, wait a second. So we can't exchange the dollars anymore. What do we do? Is there a demand for dollars? And all of a sudden, in that confusion, because of oil being traded exclusively now in US dollars, there was a demand for the dollars again, just as there was per Bretton Woods I agreement, where there was a demand for US dollars because it was the reserve currency. So I don't know if you wanted to add something in there before we jump to Bretton Woods III.
No, I think that was pretty spot on. Absolutely. So then, okay, let's fast forward the tape. We're here at Bretton Woods III now. And, if you could talk about maybe in regards to Bretton Woods II, the difference between inside and outside money also when referring to those. So what's the differentiation between those two, what that looked like between two, and then fast forward the tape to three?
Absolutely. And that's a very great question. Essentially in that article, there's two types of money that Zoltan Polzner shares in this document called Bretton Woods III. And he's talked about this in other events too, but he talks about inside and outside money. So essentially what he refers to outside money is gold, silver, commodities. I guess you can these days make a case that Bitcoin might be outside money too. And then there was inside money. And essentially what inside money is vehicles or financial instruments where there's counterparty risk. So most folks that watch the show too know that money is essentially debt. so because of through the mechanism through which money is created. And folks that want to really deep dive into that, just read The Creature from Jekyll Island, because we are essentially, since Bretton Woods II, in a global debt-based monetary system. So for every dollar that's out there, it's owed to someone. So what that means is, where it's an asset maybe of one party, it's a liability for another party. The same way with US bonds, which is essentially debt, and debt markets, biggest market on the planet. For every debt instrument, that shows up as an asset on someone's books or a liability. So a lot of counterparty risk on this inside money that he talks about. And there's a ton of examples I've just shared. Currencies is one of them, debt. Think of a lot of financial products that are out there too. But essentially, there's always counterparty risk. It's a liability on someone else's books, and it's an asset on someone else's book. So that's what he means about inside and outside money. Now, with Bretton Woods I, essentially, we still had the foundational pieces of outside money because there was some sort of gold backing in there. Right. But that switched with Bretton Woods II, as people now refer to it, with Richard Nixon closing the convertibility of US dollars to gold, and essentially took the world of the gold standard, and it switched to inside money, which is all these financial vehicles and instruments that contain counterparty risk. It's an asset on someone else's, someone's book, or it's a liability on someone's book. And this led to the financialization, essentially, of the world. Just look at what we saw through the 90s, the early 2000s, that led to the financial crisis in 2008. And for folks that want to understand the financialization, just watch the movie The Big Short, and it'll put it all into perspective for you. Yeah, it's a great movie. And now fast forward to what is now referred to as a Bretton Woods III moment. And that brings us to the war with Russia and Ukraine. Now, regardless of anyone's position on the war, if you objectively look at it, war is terrible. Human suffering, and of course, the people that suffer the most in a war are innocent people, right? Very profitable for corporations that profit from it and for bankers, but for people like us, it hurts. It's never easy, and it hurts economically too. So putting that aside and looking at this from a financial perspective and the implications of this, which not a lot of people are talking about, but that's the real story here for all of you listening and watching. The financial implications is huge, because what did we see? Well, we saw Russia invade Ukraine. So again, as I mentioned before, just take your viewpoint or your take on the war away and look objectively what's happening from a financial standpoint. Well, there were sanctions imposed by the West on Russia, severe sanctions. So sanctions that we haven't seen before. For example, foreign reserves to the tune of $300 billion was frozen by the United States and European allies. Mm-hmm. So to put that in perspective, and this was a moment of shock for a lot of folks that's starting to realize what happened, is there's a sovereign nation whose foreign reserves, which is in US dollars and a small portion in euros, was frozen and seized without due process. Again, regardless of what your take is on the war. This has huge implications and ramifications. The other thing that happened is SWIFT, which is a payment settlement system which the entire world operates on. Russia was kicked out of SWIFT. Now, most people will already know that watch this, there's already a separate payment system called SIPS between Russia and China, which they've already used. Another big, I would say, point to bring out is that Visa and MasterCard stopped doing business in Russia. Again, there's already another alternative for folks that are probably familiar with it called Union Pay. And then, of course, they went after the oligarchs, the Russian oligarchs, and about half of them, 20 of the biggest oligarchs, have felt some ramifications.
Right.
And of course, the average citizen, Russian citizen, that has absolutely nothing to do with any of this, had crypto accounts frozen and so forth.
So basically right now we're trying to figure out a way to have, severe sanctions against Russia, but balance that out with financial stability at the same time. I mean, when we're levying sanctions on, arguably the world's largest commodities producer, what is that going to be doing? What kind of shockwaves is that sending through the commodities market right now?
That's a great question, and because that is the big central theme here. So essentially, you've taken on one of the world's biggest commodity producers, and you've essentially sanctioned them, and essentially try to quote unquote cancel them in the language that we use today. Well, what has this led to in a very, very short space of time? We're talking 2 weeks. Essentially, what has happened is the world needs products and commodities coming out of Russia, big time. You just think about wheat. What does it run? About 25% of the world's wheat or something that comes out of there. And most folks just think it's food, but just think of cattle feed. And it's the ramifications is, it's a trickle down effect that hits every single part of your life, which you might not even be aware of, but most people now have started to realize that. So there's a huge demand still for products and commodities coming out there. So how does this play out? Well, now all of a sudden, countries around the world have to find out a way to do business with Russia. And because of banning them basically from SWIFT and all of these sanctions, they are now forced to go into a separate system and financial system. So the Western world operates on SWIFT and operates in US dollar, but now they're forced to go to Russia and say, how do we do business with you outside of SWIFT and outside of US dollars? And it's starting to happen. You look at the headlines now. I believe it was India, which is part of the BRIC nations, Brazil, Russia, India, China, South Africa. That was already established. As I mentioned, SIPS was already in place. Union Pay is in place. So countries are now, like India, doing business with Russia and using the Russian ruble as an instrument. That's why you've seen a spike back up in the Russian ruble, because there's now a demand for it. A huge demand for it. Russia has also made a statement and said unfriendly countries to them that still want to continue to do business with them will either have to do business with them in gold or in Russian rubles, which this is very interesting stuff. But big picture wise, you're seeing now capital flows going from west to east, and you're starting to see the economic power shifting. And of course, China is a huge trading partner with Russia. And between those two countries, the populations of those two countries, it's enormous if you look into it. So there's sort of a shift now and a split between the Western system and then the Eastern system. And then there's still countries that are neutral that are now starting to realize, well, maybe we'll use Bitcoin, such as El Salvador and a lot of Latin American countries that doesn't necessarily essentially want to pick sides right away and want to remain neutral. But from a commodity standpoint, there's going to be a lot of shortages that folks would need to prepare for. And when you have a holistic strategy, a wealth strategy for yourself, your family, your business, and your investments, you have to understand that these sanctions are going to hurt everyone. If you're in the United States, this will hurt you a lot. It's not just going to be the Russian folks living overseas there. And I've seen sanctions from a very young age. I grew up in a country that was sanctioned. So South Africa had severe international sanctions. We couldn't compete in international sports. There were corporations that refused to do business there. The first time we actually had a McDonald's, for example, in South Africa, I remember this was towards the end of high school. So I remember growing up in a country that was heavily sanctioned, saw what the sanctions produced. And of course, countries that did business with South Africa, because there was still a lot of natural resources, gold, diamonds. South Africa produces a large part of the world's platinum. How did they do business with South Africa at that time? Well, they had to pay premiums. Right. But anyway, yeah, I think the big picture here is we're starting to see a split. And then this is major ramifications with regards to commodities. And that's why you've seen the spikes of prices in commodities, where just a nickel in the United States coin has double its value just when it's melted down. Right. It's kind of crazy if you think about that. You've seen massive spikes in prices because you now have a shortages of commodities and all these fiat currencies still chasing it around, which has just led to massive spikes. And, as we discussed in a previous conversation, I don't foresee any inflation slowdown bar wild card. And I know we'll talk about that a little bit too.
For inflation hedges right now, and we love the diversification of the portfolio. We always preach that, don't have all your eggs in one basket, have multiple revenue streams as well as best you can, so that if one goes away, you still have other sources of income there, of course. Let's talk about capital, allocation, and particularly with assets. You mentioned real estate. You talked about short-term rentals. That's something we're super high on this channel. We'll drop some links to some of those videos below as well. Your mechanism or your vehicle, if you will, for folks to really get into investing, utilizing the infinite banking strategy or the infinite banking concept and whole life insurance. Can you talk about how that really ties all of this together and how you and your team can really help people with that diversification of their portfolio? Of course, if they are interested in getting more information from you, they can go ahead and email ninja@VIPfinancialeducation.com. We'll go ahead and drop that link below as well. But what does that look like, MC?
Yeah, and great points about all those areas to position capital in. As part of a capital positioning strategy, we still recommend holding cash. Cash is a buffer in your strategy. There is going to be a blind spot in every investor's portfolio. Billionaires will tell you this. They don't expect to know all the answers. So they prepare for anything and everything, but recognize that there's a blind spot. So you need a buffer, a volatility buffer within your overall portfolio. And that's what cash is. Think about a worst case scenario, something happens to real estate. Well, if you have access to cash at that stage, you'll be able to sustain a knock that came in that direction. What if something happens? There's a lot of folks talking about crypto, and that's into crypto. And I see the Bitcoin moon boy and moon girls, and Bitcoin right. fixes everything and so forth. What if there's a massive drop in crypto? And what if folks have, for example, collateralized loans in crypto? How do you fix that without losing your coins? Well, you need cash. You need access to cash. What if you run your businesses and you have a down month or something happens? There's a wild card event that impacts your business. Well, you're going to need some cash to sustain that. Cash is the one thing that can balance this all out. So where do you keep your cash? I am not a big proponent of recommending anyone keeping large amounts of money in a bank right now for many, many different reasons. That's an entire show by itself.
Yes, so it certainly is. Yeah.
Yeah. So where do you keep your cash? One of the things that I mentioned earlier was the concept of counterparty risk. So when you look at counterparty risk, it is when you're putting your money with a custodian or an institution, there's a risk to that, because what if you cannot access your capital? What if that institution loses your cash, right? And by the way, if you deposit money into a bank, you essentially become a lender to them. They just owe you that money. The way that the laws have been written since the last financial crisis, there's bail-in provision clauses and all these laws and so forth. So for me, and how we still see it, we look at who has been great custodians of capital and who has been great stewards of other people's capital. And that makes you look at the mutual insurance carriers that's been around since the mid 1800s in this country. And I always say, if you want to look at how someone's going to behave in the future, you look at their past behavior. Same thing with financial institutions, same thing with operators that you're working on. If they've done the right thing in the past and have been good custodians and stewards of other people's capital, there's a very high probability that's going to happen again. Mutual insurance carriers have been around, as I mentioned, since the mid-1800s. So they have seen many different shock waves. Some of them have seen a civil war in the United States. Some of them have seen several central banks, which the Federal Reserve is the third central bank that has existed in the United States. Some of them have seen 2 world wars. Some of them have seen through Bretton Woods I and Bretton Woods II. They've gone through all these shock waves, financial booms, financial busts, recessions, depressions, and so forth. And some of them have an unblemished record of paying dividends. One carries since the 1840s every single year, which means they were profitable. So when I look at mutual insurance companies, just by their past behavior, they've been great custodians and great stewards of capital. It leads me to believe that the probability is very high in the future that they would still be great stewards of capital and great custodians. So we utilize mutual insurance companies and we structure very specific insurance policies for a cash value as a savings mechanism to warehouse your cash in. So it's in these insurance contracts with these mutual insurance companies outside of the Wall Street casino and outside of the banking system. You can access that capital for any emergency, for your business to grow and expand, for purchasing real estate or more, and for any other needs that you might have, very, very easily. And that obviously you can access those funds tax-free. And that's why we love that vehicle. We still love it. And I'm starting to also see what's happening on the inside of the financial world, what family offices are doing. They are very big proponents of this. And we're talking now families with net worths combined of $100 million or up. They are really, really positioning capital in these vehicles because of what I've just shared. They also believe that these folks have been great custodians, great stewards of capital. Where do I position my capital in this this reset, monetary reset? Will I position it where there's a proven track record so I can access it and capitalize on the plethora of opportunities that will be available for all of us as business owners and investors during this time?
No, I love that vehicle, and that's what you talk to them if they do reach out to you with the email. That's what you guys are talking about. That's a consultation effectively about the whole life, and you guys are making recommendations. You guys are advising, how to not only get those set up, but kind of what, depending on really risk aversion, I guess, is what a lot of that boils down to, and where they want to deploy capital. You guys are advising them on that. As we continue to bring MC here on the channel and talk about specifically the infinite banking concept, because time and time again, we're getting tremendous feedback from our audience of people that have gone down that path after watching the videos that we presented with MC on here. And we just have untold amounts of tremendous feedback. So appreciate you sharing that with us. So anyways, guys, thanks for joining us here today. If you like the information, you want more videos like this, smash that thumbs up button below. That helps out our algorithms, lets us know that we're on the right track and continuing to bring great expert guests like MC here on the channel. If you're not a subscriber, subscribe below and go ahead and hit that bell. That's going to give you the heads up as we bring additional content here on the channel. Typically drop a handful of videos every single week. That said, thanks for joining us on the VIP Financial Education YouTube channel, where we talk about all things credit, capital, and cash flow. Until next time, make it a great day. Take care.